Hello, good afternoon, good morning to everyone. Welcome to the weekly session that we are going to organize for the next few days in terms of looking at the global macroeconomics. This is something we have done for many years in Washington, D.C. with UBS and other partners. So I'm glad that we can continue these discussions online this time. I hope that all of you are well. I know this is a difficult time for everyone. You know, first, health is a priority for all countries, and I hope that these discussions today about policy responses, not only in advanced but in emerging countries, will help us identify maybe global and the future global trends that we want to look at. We have a short period of time, but we have a great group of governors and deputy governors. Let me thank all of you for accepting our invitation. I think this is something that we take it maybe more than before because we have to do it not face to face. So I really appreciate your participations. Let me now give the floor to Massimiliano Castelli, Managing Director at UBS Asset Management, who will moderate the program. And I really thanks of our speakers for accepting to join us this afternoon. Max, please.
Thank you very much, Mark, and good morning and good afternoon to everybody. It is a pleasure to be here, and I would like, first of all, to introduce myself. I work in UBS Asset Management. I'm the head of strategy for central banks and sovereign wealth funds. And I'm actually would like to, before introducing our guests, we have a distinguished list of speakers to debate the latest issues on the economic policy agenda of central banks and governments around the world. I would like just to kick off by mentioning just a few remarks. We actually just finished from our 26th Reserve Management Seminar for Sovereign Institution, which was actually the first time that we had it in virtual format. So it was also first for me, at least from the technological point of view. But during that event, we had a very interesting panel with our chairman, the UBS Group Chairman Axel Weber and Yoon Song-shin from BIS, on monetary policy and central banks. And it was very interesting. I would like just to give you some of the conclusion of the topics that the thoughts came out from that panel, because I think they're very relevant for the discussion we are going to have. Just in a nutshell, we are talking about a triple crisis, as it was put from the BIS, an economic crisis, a financial crisis, and a health crisis. And of course, the central banks can play a very important role, but it was really stressed how fiscal policy this time around, in particularly compared to 2008 and 2009 and the great financial crisis, will have a larger role in supporting the economy, not only during the pandemic as we are in now, but also post-pandemic in terms of recovery. The panelists as well agree that this is the second time in only 12 years that we had a big economic crisis. The role of the bank actually this time showed the robustness of the policy measure which were introduced after the financial crisis to ensure that any shock which could hit the global economy would not translate into another financial crisis. But interestingly enough, it was also pointed out, both from Axel Weber and from the BIS, from Mr. Shin, that they see area of risk, in particular in the non-banking sector or in the shadow banking system, as sometimes it is labeled. Another aspect which I would like to highlight, which was discussed at length, was as well the issue, the link between fiscal policy and monetary policy, also particularly in emerging market economy. In particular, it was stressed that the trajectory of the dollar will be a key determinant of how the global economy can cope. And here there are also some important lessons which can be learned from the emerging market debt crisis of the 80s. Overall, it was also stressed that exchange rate could take more importance in terms of transition of the monetary policy in the post-COVID world. And then finally, I would like to mention some of the results that we had from our survey, which was presented at the conference. Every year we carry out a survey with more than 30 central banks from around the world. We ask a lot of questions about the investment side, the reserve management, the investment of the reserve, but also we ask some more generic questions, more about the macro and the policy environment. And let me just highlight three of the results that came out of that survey. First of all, it is interesting to note that in terms of the risk, in addition to COVID, of course, in terms of risk that the global economy faced, not surprisingly, trade war and the US-China confrontation was mentioned as the most important one, but from around 80% of the respondents. But very interesting, at the third place, we had the political development in the US, in particular the presidential election. This, of course, was the first time that domestic development in a country, although very important, like, of course, the US, could have an impact across the global economy. The second point was that when we ask about when do you expect interest rate to eventually rise, I think that was very interesting to hear that according to the majority, about 47% of the respondents, the Fed will not increase rate before 2023. And actually, according to 65% of the respondents, the ECB will start raising interest rate actually later than 2023. So it seems to me that also the central banks that we survey believe that we enter a very prolonged period of very low interest rate. And the third element that I would like to put on the floor, it is about the global dominance of the US dollar. In fact, we were very curious to see, also from an investment perspective, whether the demand for US dollar denominated assets, which, for instance, in the world of government bonds, at the moment, they were, before COVID, the one providing a positive return in nominal terms compared, for instance, to the euro and Japan. In fact, actually, demand for US dollar denominated asset has remained pretty strong until July of 2020, when we carry out the survey. As I mentioned, that's very important because, of course, what happened to the US dollar will also have implication, in particular, for emerging market. So I would like to mention two things. This panel, of course, we would like to get a perspective both from an advanced economy point of view, but also from an emerging market point of view. Panel point from the survey, according to 90% of the central banks that we interviewed, the developed economies are in a better position than emerging market to recovery once the pandemic is put under control. So without further ado, I would like to introduce our panelists, and I would like to welcome Pablo Hernández de Cos, Governor of the Central Bank of Spain, Alejandro Diaz de León, Governor Banco de Mexico, Rashad Cassim, Deputy Governor from the South Africa Reserve Bank, Julio Velarde, Governor Central Reserve Bank of Peru, and last but not least, Fernanda Nechio, Deputy Governor from the Central Bank of Brazil. I would like to give all our panelists 5 to 10 minutes to make some introductory remarks. And then, of course, we will have a Q&A. I will take questions directly from the participant via UBS TV. You can see that you can click on the link below, ask question. I will receive the question in my email box, and also I will be able to turn the question to our panelists. So without further ado, I would like to give the floor to the Governor of the Central Bank of Spain, Pablo Hernández de Cos. Pablo, the floor is yours.
Thank you very much, Massimiliano, and thank you, Mark, again for a new invitation to this conference. Maybe I can try to summarize from the very beginning my views, Massimiliano, using some of the comments that you made, and in particular to the summary that you provided on this discussion between Axel Weber and Hugh Singh. My view is that on this triple crisis that you were emphasizing, for sure we have already had, and we are in the middle of a health crisis. For sure as well, we are also in the middle of an economic crisis. But in my view, what we have to avoid, we are not yet there, is that this economic crisis is transforming into a financial one. And my perception is that we have still the room to try to avoid this, both with monetary but also with fiscal policy. In this introduction, let me perhaps first try to summarize very briefly the policy reaction of policy to the pandemic here in Europe and in the euro area in particular. as in the rest of the world, the pandemic has given rise to a health and economic crisis, as I was saying, that it's unprecedented in recent history. And again, similarly to other jurisdictions, economic authorities have, in the face of this situation, responded very, very forcefully. In the monetary policy domain, in the last 7 months, we at the European Central Bank have developed an extensive package of measures to mitigate the impact of the crisis. And these measures can be, let's say, grouped into two blocks. On the one hand, the ECB approved a set of measures to provide liquidity to banks so that they in turn were able to ensure access to credit for households and firms. The measures included a significant improvement to the conditions of our long-term refinancing operations, and we also eased the collateral eligibility criteria for banks in these operations, so thus, in fact, increasing the volume of funds that they may obtain. This block of measures have already been very successful. If we take, for example, the June long-term refinancing operation, participating banks received liquidity for an amount of 1.3 trillion euros, an all-time high in persistent refinancing operations, just to give an example. We also approved a second block of measures relating this time to the asset purchase program. The motivation was also very clear. Since end February, financial conditions in the euro area had tightened, with both corporate and sovereign risk spreads widening considerably. And the spread widening in the euro area was uneven. So those countries that started from weaker fiscal positions with higher debt levels and those most affected by the first wave of the pandemic witnessed a much more pronounced increase in the financing cost. And of course, this financial fragmentation hindered the transmission of the single monetary policy. So it's in this context that in March we announced the launch of the Pandemic Emergency Purchase Program, the so-called PEPP. The key difference with previous asset purchase programs of the ECB is that purchases are now conducted in a very flexible manner in terms of their distribution among jurisdictions and across asset classes, with a view precisely to try to avoid this fragmentation in monetary policy transmission. I would argue that we can safely say that today that the PPP has been clearly successful in curbing financial market deterioration in all euro area countries, and this is particularly visible in sovereign yields, which are now close to their pre-crisis levels, but it may also be perceived in other market segments, and in particular those of corporate debt. Of course, this decline, you were also mentioning this, Massimiliano, in your introduction, this decline in the cost of sovereign debt has provided policy a space for fiscal authorities in all euro area countries, a kind of implicit coordination this time between monetary and fiscal policy that has happened in many jurisdictions. And indeed, the reaction of fiscal policy has also been swift and timely in the euro area, both at the global and at the European level. And maybe I can emphasize this later point because supranational support at the European level has been this time fundamental, in particular with this approval by the European Council of an European Recovery Fund, the fund that will be financed on the capital markets with the European Commission borrowing on behalf of the Union, an amount of up to 750 billion euros between 2021 and 2026. Of course, we cannot forget about the third leg of the reaction of policies, which has been the reaction of macro and macro financial supervisory authorities, which has also been crucial in my view. Among other measures, we've seen some clarification of certain accounting aspects related to how the existing regulation should be applied to calculate credit risk to avoid mainly procyclicality on this provisioning. The authorities have also allowed that institutions make effective use of their available capital buffers to absorb expected losses, those buffers that were accumulated during the last decade after the financial sector reform agenda that was approved and implemented in all jurisdictions. And in addition, we have also recommended that institutions temporarily eliminate dividend payouts and apply prudent criteria in their available employee compensation schemes, with the main objectives of these resources to put them into capital position, to increase capital positions. And all in all, what we can say is that that this response from the prudential authorities, but also mixed with monetary and fiscal authorities, has enabled the initial impact of the crisis to be absorbed, and in particular, it has prevented the materialization of the systemic risk in the financial system. So the question, of course, what about the current situation in the euro area? It is clear that we are living a recovery that it is still partial, that it is full of uncertainty, and that it is uneven, both at the country and at the sectoral level. And indeed, not only are restrictions still in force in some areas of activities, but maybe also more importantly, it is also proving necessary to reintroduce other measures as a consequences of the fresh outbreaks of the disease. And in this context, the outlook remains highly uncertain and the risks are tilted to the downside. And it is in this context that for me, the key for economic policies is to strike now the right balance between supporting the recovery and spurring economic adjusting to the structural changes that will emerge after the pandemic, because of course it's also crucial to see that there are some structural changes in the pattern, for example, of consumption, also of international trade, even that will be here to stay. So it's important also to react to these structural changes adequately. So this means, first, to me, that it is absolutely crucial to maintain the support measures and avoid cliff effects. At the same time, given the significant heterogeneity of the effects of the crisis, in particular in this recovery phase, I think that support measures should be now much more focused. In addition, there may be also a need to adjust some of the instruments that we've been using, and in particular, for example, the crisis has already generated, we've seen it in many countries, an increase in the level of indebtedness of many firms. Thus, it would make sense, in my view, to assess the possibility of actions to support firms that do not involve an increase in financial obligations, such as, for example, by means of direct assistance, or in some cases through temporary capital injections. Furthermore, for companies that have difficulty meeting their financial obligations, streamlined debt restructuring procedures need to be available to avoid such difficulties leading to the disappearance of heavily indebted firms whose business models is nonetheless viable. And in parallel, of course, for firms with non-viable business models, an orderly market exit should be available, since this would result in a more efficient allocation of resources. On the banking front, our goal should be, as I was saying at the beginning, to ensure that the present crisis it doesn't cause serious damage to our financial system. And in the current context, it's obvious that we cannot rule out the possibility that the risks identified may materialize, or that the impact and persistence may be greater than expected. And in this sense, in the banking sphere, again, the response to the possible materialization of this risk in the case of Europe can only be at the European level, given the commitment to banking union. And then finally, on the monetary policy front, it's obvious that the combination of a very fragile and heterogeneous recovery, medium-term inflation expectations that are far below our objectives, and also the recent appreciation of the euro, which has offset a large part of our monetary policy stimulus, lead us to conclude that there is clearly no room for complacency, that significant monetary stimulus will have to be maintained until we achieve a solid recovery. Moreover, we cannot even rule out the possibility that the measures described above may have been recalibrated, or that the new measures have to be introduced in order to fulfill our price stability mandate. In this regard, I should emphasize that it is clear that the 1.3%, which is the current ECB staff inflation forecast for 2021, is not our goal. Our goal, the close but below 2%, has to be interpreted in a symmetrical manner. And finally, I think it's also important to emphasize, crucial, as we say, in the current crisis, that we should retain flexibility in the implementation of our pandemic asset purchase program to avert and to avoid any potential financial fragmentation problems. I think this is also crucial, also to avoid some of the problems that we observed in the last crisis. That's all for now, Massimiliano.
Thank you very much, Pablo. Thank you very much, Governor. It's actually, this is a perspective from developed economy country, Spain. Actually, just to mention that on Thursday, the governor mentioned the fiscal action being undertaken at the European level. Actually, on Thursday, as part of this macro conversation, we're going to have Paolo Gentiloni, the European Commission for Economy, where we will discuss in detail about that, which of course I just want to mention is the only real regional initiative launched at the global level to fight the pandemic. I would like now to move to the first of our emerging market to give, of course, their perspective. Just to mention that according to our research, emerging markets on the fiscal front have been a little bit more conservative than developed economies, at least in terms of the size of this fiscal stimulus launch to fight the pandemic. So I would like to give the floor to Alejandro Diaz de Leon, the governor of the Banco de Mexico. Please, Governor, the floor is yours.
Thank you, Max. Thank you, Mark. Please let me say thanks to the RBWC-Reinventing Bretton Woods Committee for having me in this panel. Let me very quickly, in terms of the shock that we're facing, I think it remains to be easy if it's a triple crisis or not, but it's very sure that we have a health crisis and an economic crisis with two dimensions, a supply shock and an aggregate demand shock, and we are experiencing a financial shock. I don't know if it's going to be a crisis, and I agree with Pablo that we have to make sure that doesn't happen. In terms of, this is very different to 2008 and 9 from an EM perspective. 2008 and 9 was a crisis basically in advanced economies, the US and Europe, not in emerging markets. This time around, it's a global shock, and it's a global shock to GDP, a global, in terms of emerging markets, in terms of trade, to the fiscal accounts, and so on. So it's significantly different for emerging markets this time around. In terms of the challenges that we're all facing, let me highlight first that we have, we all thought that this was going to be more transitory, and it is clearly more persistent. This shock is going to have a significant heterogeneous impact in terms of countries, sectors. We can just think about tourism, services sectors, entertainment, and so on. And it's going to have also a heterogeneous effect on different groups in societies. So these challenges are also in terms of opportunities. I think the technological divide is going to be very significant, and probably inequalities are going to be on the rise in the short term. I think that it is very important that advanced economies were very swift and strong in terms of the stimulus. I think it was crucial to break the risk aversion vicious circle that we were in March and April. And I think it has been also very important to support the global the recovery of the global economy. In terms of emerging markets, I think that we obviously have the challenge that we need to support the economy. But one key element that goes to your comment, Max, is that we have to do that without compromising macroeconomic and financial stability. In general, even the IMF has 3 brackets for debt to GDP levels, the 40% and lower, which is basically a no worry zone, the 40 to 70%, which is basically a surveillance zone, a be mindful zone, and then above 70%, which is a more worrisome levels. So clearly for emerging markets that we are basically capital importers, we need to be mindful of the permanence of our sources of finance, and debt to GDP levels are clearly critical for that. What we faced in April and March was strong capital outflows, a strong FX adjustment. This was more acute on integrated financial markets, and clearly we needed to remain resilient and basically to try to induce an orderly adjustment. Now let me go to a few points in terms of what the situation in Mexico. We have faced a very sharp economic contraction. We have forecasted basically 3 scenarios because this is a crisis not coming from the business cycle or the financial cycle. We have used 3 different alternative scenarios, a V-shape, a deep V-shape, and a deep U-shape scenarios. And they have different contractions for this year from minus 8.8% to minus 12.8%. The most recent data is closer to the first data. And for next year, a recovery, positive growth of 5.6% in a range to around 2% in the lowest scenario. So a lot of volatility, a lot of uncertainty, and a very significant shock. What we have tried to do is to induce an orderly adjustment in our financial markets. In terms of FX depreciation, we had at the worst point of the shock a depreciation of over 30%, around 33%. Currently, the FX depreciation is around 15%. We have provided ample liquidity through what we can call balance sheet management measures, not to be confused with unconventional monetary policy and asset purchase programs related to QE strategies. I think in emerging for unconventional monetary policies and QE, I think you need persistent inflation expectations below your target and both at the medium and long term. That is not the case in a large number of emerging markets. So what we have been doing in terms of balance sheet management is more or less traditional central banking, which is lending against sound collateral, basically to avoid a panic dynamic in financial markets. Now, in terms of monetary policy, we have currently interest rates in Mexico are 400 basis points lower than what they were in August last year. We have adjusted rates, I would say, in a gradual process, trying to foster orderly adjustment. And we have been of the view that this has allowed for a more, let's say, gradual and positive dynamics in financial markets. The case of Mexico contrasts with other countries in terms of inflation. We have an inflation gap, which is positive and has been increasing. So we have inflation significantly above our target, not below our target. Why is this the case? Well, in the case of Mexico, as in other countries, we have seen inflation pressures associated with COVID in three different areas. One is energy. The second is, which has been first a reduction and then a gradual increase. The second on foodstuff, which basically we have seen an increase in food prices. And the third, a reduction in services. And in the case of Mexico, we have a relatively higher weight of our CPI on food items relative to other countries. And we have a relatively lower weight of services vis-a-vis other countries, not only advanced, but even comparing to emerging countries. So the type of shock, the different weights, and also having a more acute increase in foodstuff, and this is usually associated because a lot of food items in Mexico, as we are a supplier to the US for some foodstuff, and because of the size differences, we tend to have larger swings on food prices than in other countries. So larger swing prices, higher weights on the CPI has basically entailed a different inflationary dynamic. So that's why we have been, I would say, reducing rates in a clear fashion, but still we are north of what other LATAM or other emerging markets have. In terms of other policies and the fiscal support package and so on, what we have seen is a weaker or a reduced fiscal package. This obviously leaves a higher burden on domestic aggregate demand. That means we expect to have or to see a more weak consumer recovery and also investment. What we have been seeing is that the main element on aggregate demand has been coming from external demand, basically exports to the US. And here, I think that the fiscal package that was approved a few months ago, that it is being negotiated in the US, is going to be very important for these. And we have seen that basically manufacturing has recovered in a rapid way as exports have been increasing. But as I said, we have weaker consumer recovery. And here I would only add that we're still clearly not out of the woods. We would all like to have a lot of stimulus into different areas because of the severity of the pandemic. But I think we need to be mindful to have robust policies and to basically be mindful that we can still have significant headwind. We are still, for example, in the case of the US, we are short of a fiscal package that has been on and off for some months now. There is a critical election episode in the US in a few weeks from today. And clearly, we should be ready to face volatility and complexity in financial markets and basically reduced appetite for emerging markets. I think it's been very challenging for emerging markets. We need to be mindful of our degrees of freedom and try to guard them well. Thank you.
Thank you very much, Governor. It's a different perspective, of course, from Europe. I would like to immediately switch to another perspective from Latin America. Fernanda, Nechio, please, the floor is yours for a perspective from Brazil.
Thank you. First, thank the organizers for including us including me and Brazil in this conference. So I think what I'm gonna try to do is to touch upon some of the points that you raised at the beginning, but giving a Brazilian perspective and also talking about how emerging markets in general associate with those. So, you know, in terms of Brazil, I think it's fair to say that before COVID, we had a very good perspective. You know, the economy was gradually recovering, GDP was picking up, unemployment was declining, and we had several improvements in formal employment, and that's something that I'm going to touch upon later as well. Inflation was running around target, inflation expectations well anchored, monetary policy was providing stimulus along the recovery path. The country was going through a comprehensive reform agenda, modernizing, opening the economy. Very, very importantly, we went through an important shift in the fiscal stance, reducing fiscal imbalances, reversing the path for public debt going forward. In some near-term prospects were quite good. The pandemic clouded this outlook quite a bit. Emerging market economies face significant capital outflows that dwarfed anything that we've seen in previous crises. We experienced substantial pressure in our currency and equity markets. And in Brazil, as in other economies, we implemented the much needed shelter-in-place policies, and a significant share of the economy was brought down or to a complete halt between March and May of this year. The central bank has taken several measures to provide liquidity, relax capital requirements, and improve credit and financial markets functioning. The measures were quite effective, I would say. Credit continued to flow in the economy at levels similar or above 2019, despite the severity of the crisis. The government implemented several programs, including a massive transfer program to households, some tax breaks and credit programs to firms as well. I think it's fair to say that the combination of our policies and the programs implemented by the government have allowed for a strong recovery in Brazil, and somewhat stronger than in some other emerging economies. But like the rest of the world, and as Max highlighted in his initial remarks, the recovery is uneven and also concentrated in some sectors. So we are seeing much improvements in the industrial sector and the retail sector, but the service sector that requires a lot of the mobility or requires mobility coming back to normal levels are still behind. Also in line with other economies and in also some advanced economies, I would say, we are seeing inflation readings that are pretty much reflecting the uneven recovery, with some higher readings for food items and construction-related items as well, but very muted inflation for services, for example. So again, you know, we have a lot of sources of uncertainty still. We still have uncertainty regarding the health crisis, which, you know, hasn't been solved yet. It's possible that we could be hit by a second wave, and how countries are gonna face the second wave is something that is still an open question. We have factors that are still behind mobility not being brought to normal levels. And actually we have questions about what the normal level is gonna be. Is it true that, you know, consumers and firms are gonna behave differently going forward, and for how long? And of course, we also have questions on and uncertainty regarding the impact of the reversals of the government policies that are currently in place. Now, as I said, a lot of what I said until now is very similar to developed and emerging economies. So now I think I enter into one area that is very emerging economy specific and particularly Brazil specific. So the nature of the shock that we had called for fiscal measures, and the government acted very quickly to provide a lifeline to firms and households. However, especially for the case of Brazil and other countries that already started the crisis without that much space on the fiscal side, going back to what we had, the fiscal stance that we had before, is key for the country to be able to grow in a sustainable way going forward. These measures that were implemented have to be constrained to this calamity period in which, in Brazil was defined until the end of the year in a constitutional amendment, actually. And the government needs to go back to the reform agenda. The approval of a separate budget in a constitutional amendment allow for expenses to be constrained this year alone, the extra expenses. And this was a very good step. And it should be kept this way. So it's essential for Brazil that the fiscal regime is maintained. The COVID shock was both a supply and demand shock. Demand effects have been stronger. We are seeing inflation expectations declining considerably for the relevant horizon for monetary policy. Based on our assessment of the economy and inflation readings, we lower our policy rate to 2%, which is the lowest level that Brazil ever had. And this level provides a significant stimulus to the economy. We have also introduced forward guidance in our communication, in which we make clear that we do not intend to reduce the stimulus unless inflation expectations are sufficiently close to the target. And because the fiscal side is so important in Brazil, we made also clear that the intention, our forward guidance, is conditional on the maintenance of the current fiscal regime and on the anchoring of inflation expectations. So this is a very important point, and the fiscal side in Brazil is and has always been a matter of a challenge. Going forward, I think there are a few issues that are more longer term concerns, and I think this is going to be valid both for emerging economies and for advanced economies alike, which is related to trade, as we heard in the initial remarks. We're already seeing some trends in trade, reversing some of the globalization period that we saw before. And it's possible that the pandemic is going to bring more of that, and it's going to accelerate this process. And I think another concern that we were also seeing before is a replacement of employment by technology. And, this is, of course, provides many gains in efficiency, but it means that we may end up with a higher level of a natural rate of unemployment. And that's something that it's possible that has been accelerated with the crisis as well. These concerns are true for both emerging economies and advanced economies alike, but they may be more of a concern for emerging economies because, labor is not as qualified. The level of qualification is different in those two areas, and trade changes may affect a lot the supply chain, and some emerging economies are very dependent on those supply chains. Thank you.
Thank you very much, Fernanda. I will go back on the globalization or deglobalization story, because I think it's very relevant for emerging market. But before doing that, I would like to pass the floor to Rashad Cassim, Deputy Governor, South Africa Reserve Bank. Please, Deputy Governor, the floor is yours.
Thank you very much. Once again, it's an honor to be in this panel. In some respects, South Africa is an African economy with very typical Latin American characteristics. And the problems are not that dissimilar to what goes on in Latin America. I think that what is interesting about the pandemic is that, it's put a series of policies to test simultaneously in a way that has not been the case before. At one level, there's the monetary transmission and there's monetary policy. At another level, there's a role of the central bank as a market maker of last resort, more than in many ways than one. And thirdly, many of us have the responsibility of financial regulation. And I think that, like every central bank, we put all these tools in action. The South Africa has an inflation target of 3 to 6%. Before the pandemic, the overnight rate was at 625 basis points. Today it's 350 basis points. So there was quite a bit of injection or kind of relief coming from monetary policy. Similarly to many other central banks, we wanted to defend disorderly financial markets, and we did all the necessary things to ensure that bid ask spreads are normal, reflecting normal market conditions. So there were a series of liquidity injections and transactions and so on, like many central banks. And thirdly, like many central banks, we provided relief in the liquidity coverage ratio, relief in some of the capital buffers and so on. Whether these really worked effectively is obviously open for debate. One thing that we did fairly quickly is introduce some direct fiscal measures, and as many of you know, that direct fiscal measures has an impact that's more predictable in some respects than some of the capital relief and so on. But part of the problem is that we entered the pandemic, unfortunately, on the basis of a technical recession. So we came into the March meeting, we came into March with a technical recession. We entered the pandemic with a fiscal deficit that grew quite a bit to 7% for 2020. Now, with the massive nominal shock in the economy, you're looking at close to 15% fiscal deficit for 2020. So these were some of the real challenges that you faced, and these challenges really translate into the difficulty of not only having your eye on the ball of debt ratios, but the interest burden and the net and the service payments to debt is really what stands out. In many advanced countries, your interest payments, as you take on more debt relative to GDP, may actually be declining because of the cost of capital is so low and cheap, whereas in many of the emerging markets, that's the opposite. So interest payments obviously are a very, very, very difficult situation. So you have this kind of paradox. You have an extremely weak economy. To add injury to insult, in March we were downgraded to junk status. That created more volatility in the exchange rate. We had a massive depreciation, but the exchange rate has kind of recovered a bit. That, along with the fact that you had a very weak economy, created some real difficulties. In contrast, you had a banking sector that was extremely strong, had more buffers than was required by Basel III. You had a highly dynamic financial sector. You have every time the South African rand depreciated, your net international investment position looked even healthier. So there's this kind of paradox to the South African economy. Now, one of the things, as previous speakers pointed out, the massive reduction in the nominal interest rate, at least in the initial part, had less of an impact on aggregate demand, but played a more important role in cash relief. So, people who had mortgages, people who had loans, were not spending these loans. These loans were not spending the money. So the relief from a lower interest rate was quite important. And in fact, one saw, and I'm sure is the case in many countries, that massive increase in money supply, bank deposits, and so on. And this played a really important role in creating lots of liquidity in the economy. So that was more or less the essence of it. Now, one big debate is beyond the traditional role of monetary policy, market maker of last resort, and providing capital relief. Should the central bank, should the South African Reserve Bank do more? And here I know we get into a kind of a very difficult question around, how relevant is quantitative easing for some emerging markets. And I'd like to draw a distinction between, two set of issues. The first is that, one is to ask, looking at quantitative easing in the advanced countries, what exactly is the objective of it? And the objective of quantitative easing, in the way I understand it, is you've run out of steam, you're the zero lower bound, you need to find a different set of instruments to stimulate the economy. However, if you have a country like South Africa where we still have 350 basis points, we have inflation more or less stable around 3%, the interest rate tool is eminently more powerful than, I think, balance sheet policies in trying to stimulate the economy. So in that sense, your first port of call really is the interest rate. And countries that are lucky enough to have interest rates can use these interest rates before you even start thinking of quantitative easing as a vehicle to stimulate the economy. The second set of issues, which I think is a bit more complex, something that I haven't really thought to that much, is should the central bank, provide some financing through its balance sheet as a form of relief for fiscals. But that's a different debate. We haven't kind of entered that. But I think that the key thing is one must not lose sight of the fact that in a country like South Africa, you have interest rate policies, and that remains really important. I think inflation for a country that has a 3 to 6% inflation target is very benign. It's partly a reflection of really weak demand conditions, a massive output gap. There is one thing that we kind of think is an important risk to the inflation outlook, and that is, given our kind of increase in our fiscal debt, our public debt, and so on, to what extent will exchange rate volatility become a really important issue down the line, notwithstanding the fact that pass-through has been rather muted. But anyway, I think many of the other comments were said. Let me end there. Thank you so much.
Thank you very much, Deputy Governor. I think we had a very good overview from different perspectives, from Europe and from Latin America and from an African major economy. I'm receiving a lot of questions, so I will try to really group them into different topics. The first one, which I think is the topic that probably everybody discuss, is the inflation question. I mean, I think there is a pretty large consensus that given the economic condition we are in and the sort of speed of the recovery that will kick in the next few quarters, the inflation risk in the short term is not very high. But of course, the question is more about medium-term inflation risk. And of course, the eventual rise in long-term interest rate. As I mentioned to you before, in our survey, we found that this risk is not perceived as very important. I mean, do you share that view? And what do you think should eventually central banks do if we are starting to see inflation rising faster than what is currently expected by the market participants? And maybe we can start once again from Pablo from Spain, and then we can use the same order, or if anyone wants to jump in, please, Pablo.
Well, maybe I should start by emphasizing what the situation of the euro area in terms of inflation was before the start of this crisis, which was clear, one on which the central bank, the European Central Bank, was, having the difficulties, let's say, on meeting its target a number of years with inflation clearly below our close, but below 2%. Well, at the initial stages of the crisis, there was some doubts, no? Because as Alejandro said, this is a combination of a negative supply shock combined with a negative demand shock. So the impact on inflation was perhaps not very clear. But I think that 7 months after the initial moment of the crisis, it is obvious, at least for developed countries, and in particular for the Euro area country or jurisdiction, that this has been clearly a deflationary shock. So that the demand part of the shock has been much higher, and this is not only in the short run, on which inflation developments, we are now even in negative territory. It is also due to some VAT changes in Germany, but even core inflation is at very historical low levels. But it's not only about the short term, it's also the medium term, and I was emphasizing in my initial remarks that the ECB staff projections for inflation for 2022 is 1.3%, which is a very low number. And even if you look at the longer horizon and you use inflation expectations from surveys or even from markets calculated by markets with market information, the inflation expectations remain very, very low. So in my view, if something on the inflationary front, this crisis is adding to the traditional risk that we've been observing in terms of low inflation environment that we've been observing during the last decade. And for me, this will be the challenge that the ECB will be facing in the following years. Try to curb that risk and to face that challenge. Not the opposite risk as it was mentioned in some of these questions. Thank you, Massimiliano.
Thank you, Pablo. So I'm happy to see that our survey is in line with your views. So it means that we get it right, at least in terms of the response that we had so far. I would like to pass once again to the Governor of Bank of Mexico. You mentioned actually some inflation pressure in Mexico. Maybe you want to elaborate on that. Do you really see inflation down the road once the pandemic is under control as a medium-term risk for Mexico?
Yes, actually, what we have stated, and we published 8-quarter ahead forecast of inflation. So we do expect that the supply shocks that have dominated in the short term will abate, and the significant weakness on aggregate demand will dominate in the medium term. So even though we have inflation above target in the very short term, in the 12 to 24 month ahead, inflation expectations both for core and CPI are around our target of 3%. So basically, this is transitory. But just let me highlight that I think we are seeing very interesting things in terms of monetary policy framework revisions, and the question of what needs to be revised, the framework, the reaction function, and I think advanced economies are in a different position than emerging markets. I think in advanced economies, they have been constrained by the effective zero lower bound, and they need to be mindful about this. And I think what we share is, for different reasons, inflation expectations, short and medium term in advanced economies, have been below their target for a very long time. And in emerging markets, at least in Mexico, they have been above the targets for a very long time. And I think what it is critical, it's not only changing the framework or even adjusting the reaction function, but I think that inflation expectations are a function of the monetary policy regime, but also the type of shocks that you face. And I think advanced economies have been facing a series of negative aggregate demand shocks. And in terms of emerging markets, that has not been the case, and we have been seeing more supply and other elements driving inflation. So I think it's going to be very interesting going forward, significant revisions on the frameworks and reaction functions in advanced economies, emerging markets not necessarily sharing the drivers of those changes, but receiving, I would say, the benefit of less pressure or less tension from interest rates in advanced economies. So the lower for longer is going to put less pressure on emerging markets. But that's not enough. Idiosyncratic issues, debt to GDP levels, Rashad was commenting on these, the risk of eventual fiscal dominance, for countries that have not ample or that are not that import savings at the end of the day is a critical dilemma. Thank you.
Thank you, Governor. Very interesting indeed as well, because of course, when you have diverging inflation rates, of course, the point about exchange rate becomes very relevant because they could become the shock absorber going forward. I would like to pass the floor to Rashid, if you have any comment on inflation, although you already commented as you prefer.
Yeah. Thank you, Max. Look, I think so we have a inflation. Compared to most Latin American countries, we have an inflation target of 3 to 6, and we target the midpoint. Our forecast of inflation is 3.3% for 2020 and 4% for 2021. And I think that we don't think that inflation is a problem, and there's consensus that inflation will be around the midpoint. I guess the question ultimately is how you think about supply and demand, and whether you think there's some real risks if there's supply side problems. And my definition of supply side is not supply shocks, but if there's a decline in productivity, if there are a whole lot of issues, structural issues around the economy, would that push up prices? So that's so I think that one mustn't take one's eye off the ball for medium-term inflation risk. I think the second issue is that when I look at, we're quite lucky. Food prices are very benign, oil prices are very benign, and I guess the question is, will a massive output gap act as a dampener on pass-through if these food and oil prices shoot up? Now, one factor that contributed to very low pass-through in the last couple of years was the fact that import prices, many emerging markets, found that the effects of their depreciation was offset by import prices that were going down all the way. And I think that if we all experience depreciation, we all have negative output gaps, and we have a continuous decline or stability in import prices, particularly intermediate and capital goods that we import, then inflation, the medium-term outlook is pretty kind of benign. But if one of these triggers take a different turn, then we're in a bit of trouble. Thank you.
Thank you. Fernanda, please. Sorry, I changed the order. Please go ahead.
It's okay. So I think, as I mentioned, we are seeing the recent developments in inflation as very much related to the type of recovery that we are having, that is uneven, concentrated in a few sectors. So a lot of what we are seeing in terms of pressures in prices in the construction sector or food items are related to an economy that was shut down artificially, and then you have some inventory recomposition right now happening in place. You do have as well massive transfer programs in place, which have some effects as well in prices, especially on the items that people have can consume. Basically, in a world in which we have some still restriction on mobilities, whether they are imposed or not, you do see some patterns in consumption of households and investments in firms changing relative to what we had before the crisis. So we do have those effects showing up in prices, and I think what we are seeing right now reflects a lot of the type of recovery that we have. Of course, we do have some, we experience massive depreciation of our currencies in emerging economies, and those tend to pass through as well. We have some studies in the central bank that show that the degree of pass through depend on economic conditions, on the business cycle, but also on the credibility of the central bank. So our expectation is that the pass through, as much as it's happening right now, it's not as powerful as you would have if you had an economy that is booming instead of on a major recession as we have right now in the world. So we do have some effects in all these characteristics in the short term which tend to show us or indicate that the inflation readings that we are seeing currently tend to be temporary and they're going to dissipate over time. So, from our perspective, what we are looking at right now is that in both inflation readings and inflation expectations are below the target in 2020, 21, and 2022. So we are seeing, at least for now, muted inflation expectations, and that's the type of variable that we look at in our decision making.
Thank you very much, Fernanda. I found very interesting because I can hear that you tend to agree with what came out of the UBS results. So this makes me worry because markets also believe that, and I believe that a shock could, if inflation expectations should suddenly rise, I think this would take by surprise, but not only the policymaker, but in the market as well. So it would be probably the impact would be felt across the global economy. I would like to switch for a moment more towards the post-COVID world. In particular, we heard this a lot. We are talking about globalization, digitization, the role of technology. Let me start from the globalization debate. I mean, we actually, at the same conference that I mentioned to you before, the UBS Reserve Management Seminar, we present a paper which I co-authored together with my colleague and Arturo Briz, a professor from the IMD Lausanne Business School, where we show that also using some quantitative analysis, the importance of global factors on the performance of corporates, either if you look at the stock price or if you look at the return on capital, was already declining well before COVID, in the sense that deglobalization or the slowdown in globalization was already a trend well ongoing before COVID, probably because of the change in the structure of the economy, the shift from tangible to intangible goods, the impact of technology. And for sure, COVID has provided further impetus to this trend. But very interesting, when we went through the paper, we said, the title of the paper, Will COVID Kill Globalization? And the answer that we reached at the end was actually no, but there will be winners and losers. So, because of course, each country is exposed in a different way to globalization. I would like to hear your opinion on you. Maybe we can start in a reverse order. Maybe we can start with Fernanda, that you already mentioned globalization. To what extent the Central Bank of Brazil see a potential acceleration in deglobalization impacting your country?
So I mentioned this in my introductory remarks because we do believe this is a possible risk to the longer, medium and longer term outlook. We were seeing some decline or some trends moving towards some type of deglobalization or a decline in trade in the world. And it's possible that we are get more of that after we go through COVID, right? We all experiencing, many countries here, some difficulties in assessing, for example, medical goods. And it's possible that, countries are going to be redefining what is essential versus non-essential and what they want to produce internally versus trading or outsourcing the production. So it's possible that we're going to have some impact, and that affects us in many different ways. One way that it can affect all central banks, for example, is that many research papers have shown that the globalization period that we went through allowed for the decline in inflation that we saw throughout the world. And that was true for countries with an inflation targeting regime and countries without an inflation targeting regime. So this reversal in trade patterns can have effects in inflation going forward. And that, of course, goes directly into the job of the central bank. On the other hand, from the Brazilian perspective, we kind of understand that we have some opportunities to gain out of the changes in trade patterns, maybe replacing some of the some substitution from the trade war between the US and China, for example. And, we've seen increasing trends in trade for food-related products, and Brazil has a major role in exporting and food-related products. So it's possible that we can get some gains out of this, but on the other hand, you also have some effects on some structural variables that are very important for the country, such as inflation. So it is a risk to the outlook, and it's something that we need to be looking at closely. Now, just to add something to the previous question about inflation, as much as we are seeing inflation as a temporary, the readings of inflation that we are seeing right now as temporary, we remain very vigilant. So this is a central bank with an inflation targeting regime. So we take very seriously and look at several measures of both inflation and inflation expectations. So our expectation at this point is that it's temporary, but if things change, we are taking a very close look at them. Thanks.
Thank you, Fernanda. Rashid, you want to mention?
Thank you very much. I don't have anything profound to say about the geopolitics of global trade wars, but I think in a kind of a simple-minded way, the thing that bothers us most is that if you look at the different elements of globalization, movement of persons, services, and so on, trading goods, and then financial movements and so on, I think the part that we all suffer from radically is trade in services. This was an area that was picking up quite a bit. Some countries would benefit a lot from revenue from digital technology and patents and so on. But I think that one of the specific areas where we're going to suffer quite a bit is many of us are highly dependent on tourism, and that's what we refer to as the L-shaped part of the economy, where very few are going to recover, and so on. So I think that for a central bank, there are different elements about how you think about globalization, but just at the most basic level, the interesting question is there are parts of your economy that are going to experience income losses forever, and will those income losses fundamentally revise your potential growth lower, or will it be a blurb for a couple of years and then recover? So I think that's the one angle, the kind of immediate basic aspect of the economy, where just the nature of the pandemic, the risk-averse nature of individuals, the long-lasting effect means that there are parts of the global world that were pumping away, and those parts are going to be fundamentally disrupted. They may be substituted for different kind of things. And I think that's the real challenge that we face. Thank you.
Thank you, Rashid. I would like to move to Europe because I'm very curious to hear the opinion of Pablo on this, because it's interesting. First of all, Europe is very dependent on export. Of course, therefore, there is a clear link to globalization and eventually to the risk of deglobalization. But it's also interesting because in the paper that we did, we noticed that the countries which are less exposed to the deglobalization trends are eventually the countries, of course, with the large domestic markets, for instance, the US and China. I was wondering, a move toward a less globalization and more regionalization could become a big impetus also for Europe to finally finalize the internal market, which ultimately I think has not been exploited at full in terms of growth potential and growth dynamics.
Yes, no, thank you, Massimiliano. Yeah, okay, this might be a possibility. I would say that a very optimistic possibility. Yeah, because I mean the degree. I mean we have to acknowledge that the degree of integration at the European level, even if we haven't probably reached the 100% degree of integration, but it is very, very high already. There is some margin there, but if you compare the gap that we have internally with the one that can be observed externally, and in particular the potential consequences of the globalization process outside with the rest of the world, outside the European Union, I think that the negative consequences will be much higher than the positive. So the net effect for me, it will be clearly negative. And this is, by the way, why when we are, for example, producing this forecast every quarter, I would say that during the last 2-3 years, we've always emphasized under any baseline scenario that one of the downside risk to the growth outlook was precisely a potential intensification of the deglobalization process. And I'm pretty sure that this could create, of course, negative consequences on the short term, but I'm also sure that the consequences will even be higher in terms of the potential output growth, because it is clear from this literature that you were mentioning, that Fernanda was also mentioning, that the positive effects of globalization are mainly through productivity, and of course the reverse of this process will also be seen negatively, of course, in terms of a reduction of potential output growth. And in particular, this will be the case for those countries or for those jurisdictions, and this is of course the case for the euro area, that as you were saying, Massimiliano, we have a degree of openness that it is much higher than any other jurisdiction in the world. So I think this is a clear risk, and this is the downside risk, not in the opposite direction.
Alejandro, Mexico has been at the forefront of trade war, at least for a period of time, and now, of course, there is some truth, at least with respect to the US. But of course, you look at the global landscape. To what extent are you worried about globalization and the impact on the Mexican economy?
Well, I think that trade has been changing. I think it's not only about buying and selling goods, however you get to produce them. I don't think we're going back to that type of dynamic. I think it is increasingly, and this is from the USMCA perspective, it has increasingly a higher burden on trust and more what we can say even institutional convergence. In the USMCA, items that were included, for example, property rights and patents, labor market conditions, elements about e-commerce, and even some green issues were discussed and somehow included. So I think it is changing. It's more about, I would say, trust, that just buying or selling from wherever is cheaper. That may change the dynamics that we saw in the last 2 decades. So as we go forward, I think the more, let's say, true global dimension may be easing. And I agree with that. Maybe more regional trends will be on the rise. I think this entails, as Pablo was highlighting, a potential shock with productivity effects. But I think it is a reality, and I think in terms of North America, of course, as you know, there were very heightened in terms of volatility years in terms of NAFTA and the uncertainty regarding NAFTA. Now that we have the USMCA as the new element, and it was refreshed, we do believe that it can provide a framework for a North American integration. The only emerging market in North America for geographical reasons is Mexico. So that has to be an advantage, but I do see less global issues. And also the COVID is going to accelerate that. I think the question of your paper, even though may not necessarily kill globalization, but it is going to change globalization, and probably local and regional elements are going to have a higher weight on these production decisions.
Thank you very much. Unfortunately, we are really running out of time. I look at the watch, it's exactly 6:15 in Zurich. I really would like to thank you, all the panelists, for, first of all, being very precise in terms of timing. It's not easy for a moderator to maintain order sometimes. I really would like to thank you, Alessandro Diaz de Leon, the governor of Banco de Mexico, Rashad Cassim, deputy governor of South Africa Reserve Bank, Pablo Hernández de Cos, governor Bank of Spain, and of course, Fernanda, Nechio, deputy governor of Central Bank of Brazil. This is only the first macro conversation. I really encourage you to look at what we're doing on Thursday. We are going to focus more on Europe and advanced economies. We are going to have an expert panel moderated by Beat Siegenthaler, my colleague in the Investment Bank. And we are going to have, in addition to Paolo Gentiloni, European Commissioner for the Economy, we are going to have a Jason Fuman, Professor of Practice of Economic Policy at Harvard University. It's going to be very interesting. It is a topic of great interest, what's happening in Europe. In the meantime, I would like to once again thank you everybody for participating. And I really hope that next time I will be once again in person holding this event, because it's also nice to shake hands. Thank you very much for all your contribution and your insight. Bye-bye and have a nice day. Bye.